Welcome to the CSB Bank Q4FY23 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Gandhi from Axis Capital. Thank you. Over to you.
Thank you, Ryan. Good evening and hello, everyone. On behalf of Axis Capital, I would like to welcome you all to Q4FY23 earnings call of CSB Bank. From the management, we have with us Mr. Pranay Mondal, MD and CEO. Along with him, we also have Mr. B.K. Divakara, Chief Financial Officer. Now, I would request MD sir to begin by giving his opening remarks, and then we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Chirag, and thank you everybody for joining the Q4 and annual results call of CSB Bank. So to start with, I'll give you a very brief our understanding of the global scenario and then the domestic scenario as well. So on the global economic activity, we can see while it remains robust amidst the high inflation levels, tight financial conditions and looming geopolitical uncertainties. Amidst the slow growth and tardy easing of inflation, the global slowdown impact is turning out to be less severe than expected. So far, at least, that's what it looks, but we have to wait and watch. These conditions are expected to prevail for a while, and inflation rates until inflation rates moderate significantly. Both IMF and the World Bank have projected world output year-on-year growth rates of less than 3% in 2023 and marginally above 3% in 2024. And market is expecting a 25 basis Fed rate hike in May 23, and then take a call to pause provided there are no major data surprises inviting rating action beyond May. On the domestic side, of course, the global challenges kept aside, Indian economy continues to be looked as a bright spot, both locally as well as based on some global commentary. Domestic growth was buoyant in Q4 of FY23. RBI has revised the inflation projection to lower levels and took a tactical rate pause decision in the last MPC, affirming its stance on withdrawal of accommodation to ensure a progressive alignment of inflation within the target while supporting both growth. The latest MPC announcements, the inflation for FY24 is projected at 5.2% and GDP at 6.5%. At the current inflation, as the current inflation is within the target, no rate hikes are expected in the short term until and unless there are any surprises on the strong data releases. The 10-year GSEC rates plunged from a band of 7.35 to 7.4 in March to around 7.1 to 7.15 levels right now after the policy announcements. Liquidity that has was in a slight deficit mode, went to a surplus around 2 lakh crore, and it has normalized a little bit more now. The cumulative impact of monetary action taken in FY23 is still unfolding, and the real rate of transmission is getting spilled over to FY24. As for the RBI statistics, the banking system deposits grew by around 10% this quarter, and advances by around 16% for the year. So, and also I was reading an article by Nomura that next year that growth is expected. I mean, while nominal GDP will be around 10 to 12%, but credit growth is also not expected much higher than that. So on that backdrop, let me just get into the CSB specifics of this quarter and this year performance. So overall, the performance on both top line and bottom line was reasonably good on a quarterly and financial year basis. Highlights of our performance, I'll just quickly talk about the key highlights. Improved profitability, net profit of 547 crores, up by around 19% from last FY. For the quarter ended 31/3/23, the net profit is at 156.34 crores, which is up 20% versus Q4 of last year. Provisioning buffer of around 170 crores over and above the regulatory requirements would maintain the NIM above 5% for the quarter and FY 2023 around 5.38, and 5.48 respectively. ROE improved YOY from 1.9% to 2.06 for FY23. On the liability side, I think the team put up a good show. Deposits grew by 21% year-on-year as against industry growth of around 10%. CASA ratio improved marginally Q-on-Q from 31.44 to 32.18%. Though on a year-on-year basis, there was a slight negative growth in CASA ratio. Asset growth made advance growth of 31% YOY and 12% quarter-on-quarter. Industry has grown about 16% YOY. Gold portfolio registered a growth of 48% YOY and 10% Q-on-Q. Yield on advances for Q4 FY23 is at 11.17%, with an improvement of 15 bips from Q3 to FY23. Yield on assets for FY23 is 10.92, and it was 11.21 in FY22. Improved asset quality metrics is also another key highlight. Fared pretty well in all key indicators like GNPA at 1.26%, NNPA at 35 basis points for 0.35%, and PCR 92%, which is with the write-off included. And contingency provisions accounted in the books is higher than NNPA, continuing with the accelerated NPA provision higher than the RBI requirements and contingency provisions. We have fully provided the SI portfolio in line with the RBI guidelines. And on the capital, in spite of a growth of almost 30%, the CRAR is above 25, it's around 27.10%. Low proportion of risk-weighted assets compared to the industry has helped us in this. And on the shareholder value creation, book value per share has reached 176, EPS 31.55, ROA 20.35%. On the investments, we are making major investments into branches. So we plan to open at least 100 more branches in FY24. Working on technology enhancements, lending systems, liability systems, payments, channels, core system. I mean, there's a host of work that is going on the technology side, and a major investment this year. I mean, this year our major investment will be on technology, distribution, people, and channels. And also we will become a truly pan-India bank, because more than 60% of our branches, incremental branches this year, will be North and West regions. In conclusion, the success of our organization has 4 elements in it: vision, aspiration, passion, and execution. Our vision for now is SBS 2030, which is the sustain, build, and scale theme launched last year, which is well imbibed within each and every CSBN, and they are translating into reality. The entire team is aspiring for this to happen and working passionately towards it. The achievements in the year gone by have boosted our confidence as far as execution is concerned, and we embark into the most crucial build phase of SBS 2030. In FY24, we are planning a lot of investments, especially in the technology space, which I just talked about, where payback period will be closely tracked. We know that it will be an exciting journey, and the kind of synergistic approach we are taking within the bank will continue to expand our footprints pan-India, and we will remain focused on our current goals, and we hope to have an even better year next FY. With that, I hand over the conference to and in case Mr. Devakara, you want to add a few points, post which we will hand over the conference back for the questions.
Nothing specific from my side, Pranay. You have elaborately covered it. So as during question answer session, if anything needs to be clarified, I will chip in.
Sure, thank you. So we can get into the Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Jay Prakash Toshniwal from LIC Mutual Fund. Please go ahead.
Hello. Good evening, sir. Thank you for taking my question. Two questions. One, first on if you can comment on any more HR hiring which you are looking or which you have done in this quarter on the senior leadership side.
So we are almost 70% done on the senior leadership side. So, and when we say senior leadership, now we are no longer looking at only CXO level, because CXO level almost 80% is done. We are looking at CXO plus 1 and CXO plus 2 as well, and we have significantly enhanced that side of the leadership strength out there. We are also doing a lot of hiring on the front end as well, and every product vertical and every business vertical and support vertical. So we are enhancing everything, because the way we are planning our growth next year and for the next 7 years till for our SBS 2030, we are not looking at a single or 2 or 3 products. We are looking at whole service franchise, and for which the only way to do is to create the right verticalization, so that there is a clear focus on this, and then integrate the verticalization through a common kind of a platform. So because of that, we have actually significantly hired a lot of senior people in the last 6 months, and we'll continue to have more hirings there. So last year, overall, our number of people we hired was around 2,200. This year, which is around 46 or 47% growth in terms of manpower. Next year, we are looking at even higher growth in terms of absolute number, and in terms of percentage growth, it should be almost similar what we grew this year. So we'll continue to invest into our human capital franchise.
Great, sir. Thanks. And on the SME loan book side, we have seen a sequential improvement this quarter. Is it more to do a market or a function, or is it more to that you have the system, teams in place, and now there would be a sequential uptick, and at least on the SME portfolio side?
Sure. No, great question. I told this before. Again, I'm repeating that. One is we took last year as an opportunity, because, I felt in the first 3 quarters, somehow, at least from our risk appetite, the pricing of the risk was not happening in the market. And given we are a bank with a NIM of 5% plus, and given that our risk appetite is very, very low, so we didn't want to significantly expand the business when pricing of the risk was not to our appetite. However, we saw that changing in the Q4 of this year, of last FY. So if you see, our Q1Q growth is around 10% on SME last quarter, and we hope that we will continue the momentum going into next year unless the market scenario changes. At the same time, we also exited a lot of accounts last year. Some we exited because we didn't like the business, and some we exited because the kind of rates which they were asking, we didn't want to participate there. So, but in terms of absolute growth in limit setting, etc., we did a pretty good job in Q4. So we are happy that momentum is starting to pick up now. Also, we are going pan-India in terms of our SME growth, in terms of franchise. And one of our main models will be to work with every branch, and we are launching our current account and the Canny team, by which between the SME, the current account team, and we have also launched transaction banking. And we have got a very senior resource who is heading the transaction banking. So between these 3 triangulation will ensure that our SME business starts picking up this year now. So this will be our growth engine for the next 7 years.
Great, sir. Just last question on data keeping, sir. Your CAR increased to 27% on a Q&Q basis, while the profit is kind of same as Q3, and we also have the risk RW to total asset is increased. So if you can help us to understand the reason behind CAR increase.
I think Mr. Divakar will be able to answer this question better. Let me try, and then I'll hand over to him. I think one is our some of the backing in of some of the profits which also comes in. Also, risk-weighted assets is also low because the gold portfolio has grown faster, and hence our risk-weighted assets to that extent is doing well. But let Mr. Divakar answer this.
Yeah. Apart from that also, so as per RBI guidelines now, for taking advantage of this external rating, we need to incorporate bank's name. So somewhere else in some of these cases, though they have promised to include our bank's name, they couldn't do it. So with the results of about almost 1,000 crore of this risk-weighted assets have gone up on account of non-inclusion of bank's name in this external rating we exercise. So otherwise, by and large, it is in line with movement in credit enhancement. So apart from that, this is also one of the major reasons why, despite having shown a higher profit growth, this capital adequacy has not moved in tandem with this profit growth. So maybe that is going to be corrected this year. This is what we have been told at the time of next annual exercise of this external rating. They said they have promised to include our bank's name. In quite a few cases, they couldn't do this. So that's why we couldn't get advantage of this AA or AAA.
Sorry to interrupt, sir, but just because the Q3 to Q4 there is a 200 basis point increase in CAR, while our RWA to total assets has also increased from 38% to 40%. So you think 1,000 crore is because the CAR should be up more than the current number. That's what you're saying. I didn't get this answer.
Yeah, because that is March 31st was the deadline for this exercise to be completed. No, that impact was felt in this quarter only, not in the earlier quarters. That is one of the reasons. So otherwise, even credit growth has happened. No, so Q4 growth was quite sharp this quarter. So these are the two main reasons.
Okay.
No, I think Mr. Divakar, the question is asking is that in spite of the fact that risk-weighted assets has gone up, how is it that we have been able to show a sharp uptick in our CRAR when risk-weighted assets? I think because of primarily the profit growth and the balance sheet growth, right?
So profit will be reckoned only at the year end. So first 3 quarters, though we have been making profits, we couldn't get that benefit. For capital adequacy purposes, that gets accounted only in Q4. So only when the annual published results are announced.
Got it, sir. Got it. Thank you. Thank you, sir. Thank you. I'll come back in the queue, sir. Thank you.
Thank you. Our next question comes from the line of Pruthul Shah from Anubhuti Advisors. Please go ahead.
Yes, thank you for the opportunity and congrats on great set of numbers. My question is with respect to the loan book distribution based on interest rate methodology. So what is the proportion of loan book which is repo linked, MCLR linked and fixed rate, if you can give a number?
Mr. Divakar, you will have that specific number? I know broadly, but if you have that specific number, you can give, otherwise I'll give the broad numbers.
Can you just a second, sir. The rate of interest is 58%. So because predominantly we are into this gold loan business, that is why 58% is fixed rate of loans.
27.
MCLR 27% and repo linked is 11%.
Okay.
So broadly, the way it is, the corporate book is primarily MCLR linked. The SME is primarily repo rate linked, and on the gold loan is mostly fixed rate. And on retail, it's a mix of both fixed as well as variable rate. But it broadly mirrors the portfolio mix in the bank.
Okay, got it, sir. Got it. And sir, one another question with respect to cost of borrowing. So QOQ, if we see the cost of borrowing has gone up in this quarter. So what was the main reason for it? Whether it was and also our credit deposit ratio has gone up this quarter. So is it that because we are getting opportunity in case of advances, we are borrowing at a higher rate? Is this the understanding correct? Would you like to comment on that part with respect to cost of borrowings and CD ratio both?
So I will give you my perspective on a macro and at a kind of a high level. Then Mr. Devakara can dissect the numbers. So we are very clear that the scenario where we are in on the global banking scenario, and we cannot be completely insulated from what is happening globally. And in a way, we also heard that from RBI governor's speech, which was published in media today, is the liquidity management and the capital management is of top priority of the banking, because that insulates the banks from any kind of unnecessary risk. So while none of that is hitting the Indian shores today, but I think we need to be prudent. So from that perspective, on the capital side, we are very well protected because we are one of the highest CRA ratios in the banking ecosystem. On the liquidity side, I was very clear that we are looking at growth. Strategically, I'm saying we are looking at growth for the next 7 years. And when you are looking at growth, and I've said this before, that I'm willing to sacrifice margins for growth. Okay, so because ultimately we are building a large franchise, and we leverage this franchise over the next decade, 2 decades. So given that perspective, few basis points here and there, I don't want to lose my sleep on that. So given that perspective, we are very clear that we will focus on ensuring that our LCR, our liquidity, and our ability to grow the asset side is not constrained by any kind of a liquidity risk or any kind of a liquidity availability. So given that perspective, we have grown our deposits twice the system, which is 21%, this is 10%, that's number one. And even with all that, if you look at our CD ratio if you look at all the private sector banks, we are well within that range, actually on the lower end of that range. And I think we're 83%. If I remember the number correctly, and on the I think 83 to 84%, I think somewhere there, and on the in spite of doing all that, and in spite of the fact our broad comfort is between around 5% on NIM, we have been able to retain the NIM at a very, very healthy rate. So at this NIM, and with this growth and with this level of LCR, I'm quite comfortable in having a few basis points going up on the cost of borrowing or cost of deposits. I have no issues with that. And the good news is that we are seeing that 10-year GSEC is tapering down. And hopefully the rate cycle is coming almost to a close to peak. So given that, I think our strategy is playing out very, very well. The other thing which we have done very tactically is we have not taken long-term deposits or long-term CDs. We have kept our this thing pretty short-term. And to that extent, whatever is there, we are not going to get bound by hard rate for too long a time. Once the interest rate starts getting flat to starts coming down. So overall, strategically, we are going this way, and I'm pretty confident that we should be able to be closer to 5%, 5% plus for some more time. And given that perspective, we are quite happy in building some buffer in the liability side. So that's broadly the strategic perspective the bank has.
Okay, sir. And also one thing that this quarter gone, RBI has increased the repo rate, but we have reduced our MCLR in the same quarter. So what's the strategy there? In case you can comment on that part.
I will request Mr. Devakara to answer this. But before that, I just wanted to add one more point in my previous response, that we have also tactically brought down, for example, a CD. Last year on 31/3/22 it was 520 crores. This year we ended with only 96 crores of CD. 2023 March. So which means that most of the liability side of the business you're seeing are mostly deposit focused and hence core franchise. So with that, Mr. Divakar, I would like to answer that question on repo rate and MCLR.
The marginal cost MCLR has been reduced by few basis points so because it is being computed as per RBI guidelines. So this operating cost slightly it has come down. So based on that formula only it has been worked out. But it is not that quite steep. So it's only by a few basis points only it has come down. And that has been passed on to the customers because our MCLR is already very high. So we thought as and when some opportunities are there to pass on the benefit to the customers, why can't we do that? So based on that, it has been done.
Okay. Got it, sir. Thank you. I'll get back in the queue.
Thank you. Our next question comes from the line of Samrat Jadhav from Prosperity Wealth Advisor. Please go ahead.
Yeah, am I audible?
Yeah. Yes, Samrat.
Okay. Yeah. So two questions. One is we had an impact in NIM quarter on quarter. Right from first quarter FY23, there was a good increase, and then we had a drop in last quarter. So what could be the reason behind that?
So as I said before that, in general, I'm not saying guidance, but in general, in my all my previous analyst calls have said that we are quite happy to have a NIM closer to 5%, but we'll focus on growth because NIM by itself doesn't mean anything. Which you have got the growth, which is double than the system. But on the NIM also is a function of the mix of businesses, the cost of funds, and various other things, right? So to that extent, I think we are on a year-on-year basis. If you look at NIM, it's looking okay. Maybe on a quarterly basis, it is slightly tapered down. From that perspective. So I think it's 5.38.
42 is down, basically.
5.38 for the quarter.
Yeah. So for the quarter, it has been slightly down, but when you look at Q1 vis-a-vis Q4, we are pretty much okay out there. And when you look at Q4 last year vis-a-vis this year Q1, we are almost similar. So I think this will play in this range between 5 to 5.5. And we hope to retain at this kind of a level. So we should not have a problem with this. But we are quite happy being in this range. Too high a NIM is not sustainable when you are growing a franchise consistently.
True. Okay. And you also said in your remarks that you have an aggressive target of opening 100 new branches.
Right? That's right.
Yeah. So that would be for the full financial year?
Yeah, for the full financial year. So I'll tell you that strategically what the thinking is that we are going to start focusing on building the CASA franchise now. Okay, I'm sure some question will come on CASA at some stage, so let me just upfront it. And hence the CASA franchise will not be built on gold loan focused branches. So we are expanding significantly in North and West. Almost 50-60% of our new branch openings, almost 60% of our new branch openings this year will be in North and West. Along with that, we are building products which will help us in building the CASA. CASA is not always grown by just focusing on liability. So we will start retail assets. We are starting payments. We are starting SME in a big way. We are building transaction banking. We are focusing on current accounts. In a way, both savings and current are nothing but float. That remains in the account, depending on either transactions or usages. So to that extent, we have to start building, and we have significantly grown our new acquisition this year, and we want to get significantly more new acquisition next year. So we are building a fairly large team to get new customers to the bank. And new customers to the bank only helps when we have the right products and services and the technology to onboard them and cross-sell other products. So this entire journey is a 3, 4, 5 year kind of a journey, and we are starting it this year. And significant investment on technology is going to help us in scaling this from FY25. So our CASA journey is in a way, we are kind of teeing off this year, and this will see larger scale over a period of time. And hence, as we see FY24, we should see similar kind of a CASA ratio as we are, while we continue to grow at a similar kind of a pace next year, both on deposits and on advances. So that's the broadly what we are kind of strategically thinking of. So on the branches, I said that yes, we'll have 100 branches minimum, and out of that 60% will be in North and West, and these are not necessarily golden branches.
Okay, great. That's it. Thank you, and best of luck for the next year.
Thank you very much.
Thank you. Our next question comes from the line of Shirish Vaze from Money Life Advisory Services. Please go ahead.
Thank you, sir, for taking my question. My first question is regarding our gold loan origination. Can you provide me with the split of what percentage of our gold loans are we currently sourcing in-house, and what percentage are through externally through direct assignment, securitization, other means? Thank you.
So this is an easy one. So the gold loan portfolio, what you're seeing, has nothing on direct assignment. The direct assignment portfolio is reported separately, and that comes under the wholesale banking of business, which we do through some of the NBFCs. But gold loan business which you're seeing are all organically in-house acquired customers within the bank.
Got it. Thanks, sir. My second question is around our treasury strategy. So I can see that we have a duration of about 4.57. So I just wanted to understand how are we thinking about the duration strategy going forward? Like, are we going to be increasing the duration of our treasury portfolio? Like, if we have a view on our interest rates, or are we going to be conservative and sort of holding low duration securities for now? Thank you.
So thanks for the question. So I will give a partial answer, and then Mr. Devagara can add to that. So obviously, in the overall global scenario, the way things are playing out, increasing the duration may not be the right kind of risk strategy, or even from optically, it may not look the right thing to do. So we'll obviously watch things out, because treasury strategy can change depending on how the macro changes globally and in India. So what I say now may change after a quarter, or after 6 months, or after a year. But right now, the way we are seeing, and there are, I mean, as you know, that the yields have softened a little bit, the 10-year. So from that perspective, I think we can tactically move some portfolio and book some not only profits but also reduce the duration of the portfolio. So I think we will use those tactical opportunities to ensure definitely we don't increase the duration of the portfolio. Mr. Devagara, you want to add anything to that?
No, M duration of AFS portfolio is already 0.37. It's only on account of this HTM. So we don't have anything in HFT also. So only in HTM it is at 5.61. So overall it looks 4.57. But AFS M duration is hardly 0.37%. So we don't envisage any issues on this.
Yeah, but I understand the question what you're saying. So I'll tell you what I had done when this issue happened, etc. So, and this is for the entire banking ecosystem. So even when you are in HTM, you can say that hypothetically, what happens if I'm not saying that is going to happen, but I'm just saying what happens if you do a hypothetical calculation of M2M on a HTM portfolio as well, and we do all the calculations and we see what are the risks, what are the this thing, and what are the challenges, etc. So given that perspective, I think what Mr. Devagara is saying is right. At the same time, there will be tactical opportunity, which I say that you can move one time from HTM to AFS and A, book some profit, B, reduce the duration and things like that. So we look at those tactical opportunity, but overall, broadly, things don't change because we are not into majorly trading, and we, as Mr. Devagara just said, that we don't keep too much of AFS in our portfolio. So that's our strategy. It's not a major, we are not into majorly trading into this kind of portfolios. But duration, I don't see how it will significantly go up from here.
Got it. Thanks, sir. I'll go back in the queue.
Thank you. Our next question comes from the line of Mona Ketan from Dolat Capital. Please go ahead.
Yeah, hi, sir. Good evening. So my first question is on the cost of deposits. So we saw this rise of 55 bits Q on Q rise in cost of deposits this quarter. So one, I just wanted to understand what exactly led to this, and two, assuming that there is no interest rate increase, what sort of rise in cost of funds per quarter could one sort of anticipate, broadly speaking?
Thanks, Mona, for the question. In a way, I partially answered this question already, that we wanted to ensure that we have enough buffer and dry gunpowder in the system to grow, not only for last year and last quarter, but on a sustainable basis. Especially when our NIM and other things are looking very good. So I don't, somewhere you have to ensure you take a call. So given that perspective, we have ensured that our LCR and our CD ratio and our liquidity is extremely strong. Having said that, when so much of increases happen on the repo rate, at some point of time, somewhere some increase will happen on the cost of funds also. On the cost of deposits also. So, and that has happened this quarter, because if you see, for us, this never happened in the whole year, right? This is only in one quarter which has happened. Last year we ended at 5.29. Last quarter we ended at 5.24. Where RBI will tell us that you are not transmitting this thing to the customers. No, so we also have to be looking at that, and that's little more on the lighter side. But having said that, I'll tell you what we did tactically. We said that we will keep it little more shorter term. Okay. We will not, because we knew that there is a reasonable likelihood of GSEC flattening out, and hence we didn't take too much of a longer call. And that takes me to the second part of your question, which is what would be the outlook ahead for the next few quarters or next year. I think outlook ahead is reasonably flattish from here, and we don't see too much of growth on cost of the marginal growth can happen, but I don't see anything which will impact on NIM to that extent, which eventually actually impacts your P&L positively or negatively. So that is not keeping me awake at night, the NIM and this thing, cost of deposits at this point of time.
Okay. So when I look at your, so I see that most of the rise has come from higher term deposits. Now, when I look at your quoted rates or card rates, they have not necessarily increased over the quarter. So is it like a lot of wholesale term deposits coming at higher cost, short term, or something like that?
So, see, you know how much business happens in a tight liquidity situations on card rates. Okay, we all know that, and we were at least I can tell you that we were lower than some of the larger banks where we are quoting even, but nothing is really wholesale as such. Most of these are retail. By RBI terminology, these are wholesale because these are more than 2 crores. But these are actually mostly retail customers, except for 1 or 2 maybe wholesale customers were there. But mostly these are retail customers. The way we know means retail branch banking source them basically from that perspective, but they could be slightly larger ticket size. Secondly, none of these businesses which we did, I was very clear that we are not going to compete with some of the banks which are giving very high rates. We are not competing there. I said that only when the top 3 largest private sector banks, there I said that either will match or will not do the business. So to that extent, this is mirroring what the larger part of the market was and not some of the players which were giving, because we didn't participate there. And thirdly, the benchmark rate, sorry, the card rates, generally one do it very carefully because you have an existing book. You have existing, for example, savings book, FD book, renewals, and all of that stuff. So you know how this entire thing plays out. So one would handle the card rate very carefully. Otherwise, the cost of funds can go up very, very high. So that's a way. I mean, that's a very standard practice across all banks. So we have followed that. But yes, to some extent, special rates, if you can ask, special rates had gone up last quarter a little bit for the entire ecosystem and the industry, and that is true for us also. But we have not given crazy rates in the market to buy business. We have not done a single deal which is higher than any of the three largest private sector banks, at what rate they are doing those businesses.
Mm-hmm. Got it. So, I mean, the kind of rise we are seeing in this quarter, it's not something that will be sort of replicated in the subsequent quarters, maybe 20 bits per quarter or something.
See, I cannot, do that kind of a splitting of hair at this juncture. It's almost like crystal ball gazing. But what I can tell you is that I am not worried on this. I am going to protect my name to a great extent, and I'm not at all worried about name, and I don't see cost of deposits really. I mean, maximum 1 or 2 quarters here and there, little bit, few basis points here and there can happen, but eventually it will actually start tapering down after that because we have not taken long-term funding. So that was done tactically as an ALCO decision, and that is exactly how it is playing out right now.
Sure. And secondly, on the loan to deposit ratio, you mentioned you are at the lower end of, average for private banks at 84% or thereabouts. So can one assume that loan deposit ratio can continue to rise from here on, or it has reached that, level where it should remain closer to where it is?
So I think it depends actually on our credit growth next year. Okay. So if we are at around, let's say, if the market is at 10-12%, and if we grow by, let's say, 20, 22, 23, 25%, then we should be able to retain this kind of CD ratio. But suppose we do a better job and grow the book faster, then I don't mind having a CD ratio because 86, 87, 88% CD ratio I have lived with in my past in my previous organizations. It's not a big deal. So as long as it remains below 90% for a good cause, not because we cannot mobilize liability, but because our credit growth has been faster because all the cylinders are firing, I would not lose sleep on that as well. So, but we will never go above 90%.
Got it. And on the fee income side, so we've seen a very strong uptick in fee income this quarter. And the entire fiscal as well. So could fee income continue to grow at a higher pace than loan growth, something we saw in this fiscal?
This I can tell with definite conviction that it will grow much faster than the loan growth. Okay, I'll tell you why. And this is something, and actually, if you look at most of our operating metrics, Mona, most of the operating metrics, if you follow my analyst calls in past or our one-on-one meetings, most of these trajectories are exactly moving in the same line which I have talked about before. And that's what gives me and my management a lot of satisfaction that it is moving exactly as predictable, each of the operating metrics. So on this fee income, let me tell you, which I had told before, that we had a significantly lower fee income this year on treasury and on PSLC income. I think between the two, we did almost 31 crores lesser than last year between the two. Okay. In spite of that fact, we have grown by 28% on the fee income, which is in line with the credit growth. Next year, the PSLC income will come back for reasons which I've explained before. Right. And we do have a very good PSL book this year as well, and our momentum on the processing fees will only go up because with credit cards and retail assets and SME businesses coming in and transaction banking getting launched, the granularity of the fee income is only going to improve significantly. And our TPP business, trade, forex, we are focusing a lot more on NRI and trying to ensure that our some of the remittance happens on the NRI book directly through the bank. So all of these will give us significantly higher traction on fee income. So I'm very bullish on the fee income. I said that sometime back, if you take ex-treasury and ex-PSLC, our fee income is to be less than 5% of the total income. And I said that at some point of time by SBS 2030, we should be somewhere around 17-18%. In fact, we are ahead of that trajectory. We have almost reached, I think, some 13-14% or something like that, or 15%, I don't know. So I think, or at least definitely, I think in the next 2 years, we should be able to reach at least 15% of our coming through the fee income of the overall income, which will be then we are in the same league as the big players. So I think we are well on track on that front, and this is something which is doing very well.
Got it. And so if I look at this quarter, the 44% growth in the core fees, which is commission and processing fees. So this already included, or what has this benefited from? Is it the same things you mentioned, cards, trade, forex, transaction fees?
No, those are not yet come. So this has come primarily from gold, insurance, some debit card, credit cards, small little here and there, ATMs and all that. And so mostly it is, and liability fees, of course, the standard liability fees, which also has grown. Because as you add more customers and this will kind of grow to that extent. So I think we have done the basics right. Next year we'll add on few more cylinders to it, and these basics which you have done right, some of them will fire even better next year. So I'm pretty confident that on the fee to total definitely fee income will grow faster than, and next year we'll not have a negative growth on treasury and PSLC. In both we will have a positive growth. So if you add all it up, there is a reasonably good traction you will see on the fee business.
Thank you. Ladies and gentlemen, in the interest of time, please restrict yourself to one question and one follow-up question. Our next question comes from the line of Sheel Shah from Samiksha Capital. Please go ahead.
Yeah, thank you. Thank you for the opportunity. So we had a great year in terms of asset quality, and we saw improvement each quarter. And we had a negative credit cost for 2 years in a row, and now it is definitely outstanding. For FY24, can you please share credit cost guidance and your thoughts on slippages for FY24?
So before that, let me just tell you what happened in FY23 and what is the good news in that. Other than recovery from return of book as well as upgradation of accounts, I think the other factor, which is slippages, is something which makes me very happy because the slippages has been pretty positive for us, the entire trajectory. So what it tells us that our risk management, our credit governance, and all of that is working very well for us. So that's number one. And hence, going ahead into next year and future, we see that we have a good risk and credit governance, which finally leads to credit cost, right? Secondly, on the credit cost, yes, we had continued to improve on our credit cost, and we were more negative this year than last year as well. I think it is around 25 basis points, I think, negative this year, compared to, I think, 7 basis points last year. But this, of course, this cannot continue forever as you grow your book. So what I have told in past, I'm telling again that our GNPA will be less than 2%, NNPA will be less than 1%, and our credit cost will be less than 40 basis points. And this I'm saying at least for the next 3 to 4 years on a CAGR basis. So I will hold on to that. Having said that, obviously, given the trajectory, we may not have a negative credit cost, but we may not reach that higher end of this limit. I mean, higher end of this range. So we should be doing reasonably well on our credit cost next year as well, and well below the 3-4 year guidance.
Okay, thank you. Just one quick question. If you can just share a total investment in tech that we have done for the current year.
Total investment?
Yeah, in a tech investment.
Tech investment.
Yeah.
So what we have done is we have built the structure and the architecture and clarity on what we want to do on technology this year in FY23. The leadership team is in place, the structure is in place, and we have clarity what we want to do. The easiest way to say what we are doing in technology is almost 70-80% of what is there in the bank won't be there after 2 years. Okay, whether it is the core system, whether it is the LMS, whether it is the LOS, whether it is the corporate net banking, whether it is the entire API integration. I can go lead management system, the entire project management system. I mean, whatever I talk, the entire architecture. So we got full clarity this year how much we started investing this year, but the big investments are coming in the next 2 years. So in terms of capex, most of the capex will be through in the next 2 years in the bank, which obviously on accounting principles will flow through over X plus 3, X plus 4 basis. And hence it's not that everything will hit the P&L, but maximum investments in terms of capex will happen in the next 2 years in the bank. And after that, obviously, we will continue to do bits and pieces here and there. And that's where the major investment will come in FY24 and FY25. And we'll try and see if we can execute it right. A lot of that will get front-ended in FY24 itself. This is a big investment for us, and this is a big strategy for us next year.
Okay. Can you just quantify it?
It's a difficult number to give, but what I can tell you is that in terms of, because I've told it before, I can repeat it, that our whatever our annual profits are, hopefully we should be able to invest that kind of a money in capex. Obviously, it will get apportioned over 3, 4, 5 years.
Okay. Thank you so much.